Welcome to this presentation on Fiore Gold. With us today is Tim Warman, who's Chief Executive Officer of Fiore. And without further ado, I'll let Tim start in on the presentation.
Thanks, Jacob. Thanks, everyone, for taking the time to listen today. As Jacob mentioned, I'm Tim Warman, CEO of Fiore Gold. We are a U.S.-based gold producer. We have 3 projects in the U.S. right now. We have our producing Pan mine. That is the cash flow engine that drives the growth of the company. We have our Gold Rock project, which is our growth project. It's a permitted growth project right next door to Pan. Both these projects, for those of you who aren't familiar, are in Nevada. And then we have a third project called Golden Eagle in Washington State, which is actually quite a large project. And I think there's a lot of value to be unlocked from that. But fundamentally, our goal is to become a small to mid-tier U.S. gold producer. We're looking at a target of 150,000 ounces a year as our first step. We're currently producing just under 50,000 ounces. I think we just did 46,000 ounces and change in the most recent fiscal year, but we're looking to grow that through developing Gold Rock and through some strategic M&A, mainly U.S. focused. And the reason for that is because right now, if you're a U.S. investor looking for a safe jurisdiction, 100% domestic U.S. gold producer, we're currently the largest one at under 50,000 ounces a year. And we think there's a real niche to be filled for 150 to 250,000 ounce U.S. domestic producer, particularly for U.S. generalists and who don't have time to research the jurisdictional risk of places like Kazakhstan or Papua New Guinea or Mexico for that matter. Just a quick note on the pandemic and our response to it. Obviously, like everyone, we're working from home. Except at the mine, and at the mine, we're taking a lot of precautions. Fortunately, Northern Nevada has been relatively lightly hit by this. It's a thinly populated area. And to date, we have had no positive tests. So it's been a bit of a headache operationally, but overall, it hasn't impacted our operations materially. We're still able to produce gold. We're still able to get reagents and supplies. We're still able to sell our gold and operate the mine. So we've been very fortunate in that regard. Geographically, as I said, we are entirely in the U.S. and really in the Western United States. The Pan mine is our operating mine. It's in northeastern Nevada in White Pine County near the town of Ely. It is a typical open pit heap leach oxide Carlin style mine. You'll find these all over Nevada. Here you can see it from above. 2 pits, imaginatively named the North Pit and the South Pit. We haul ore from both those pits into the leach pad at the center of the screen there. We have a crushing system there, and we crush the ore and place it on the leach pad. Irrigate it with leach solution, and the gold in the liquid reports to the ADR plant where we extract it from the solution and produce gold doré for sale to the refiners. It's almost exclusively a gold mine. We produce very little silver, very little copper, or anything else like that. It's a very clean mine. It's also, and this is something we're extremely proud of and would like to highlight, it's a very safe mine. We have never had what's called a lost time injury or an LTI in the history of the mine. And we have been the safest mine in Nevada for 5 years running now. We have won the Nevada Mining Association's Safety Award for mines of our size every year that we've had this operation. And that's really an almost unheard of achievement. And the key thing about safety is a leading indicator for how efficiently and how well run your mine is. And I think our safety record speaks volumes about how well run Pan is. Just some notes on production and the history of the mine. This is the 3rd full year of the mine in production at full rate. We acquired the mine in 2016, put it back into full-scale production in September of 2017. And September is coincidentally the start of our fiscal year. So we just finished fiscal 2020 at the end of September. We're into our fiscal 2021 now. But you can see over the last 3 years operating the mine, we've had a steady increase in gold production. That will start to taper off now as the mines kind of hit steady state, a sort of mature operation right now. We've been focused very closely on costs as well. It's not a terribly high-grade mine. It runs at about 0.5 gram per ton, which is not the lowest grade mine in Nevada, certainly by any means. But we do have to keep our eye on costs, and I think we've been pretty successful at that. We typically run between $900 and $1,000 for cash costs or all sustaining costs at the mine basis, and then somewhere between $1,100 and $1,200 at a corporate level. some back-to-back record quarters. This has been a great year for us. We produced over 12,000 ounces in each of the last 3 quarters, generated some pretty solid cash flow, $3.9 million in operating cash flow in Q2, $10.5 million in Q3, and you can see the earnings there very strong as well on a per share basis. From a cash generation, we generated about $8 million in free cash flow in Q3. And this year we've added another $5 or $6 million in cash to our balance sheet, which is currently sitting at about $23 million in cash and no debt. So with Pan running relatively smoothly, the focus now is on mine life extension. The plan is that every year we will spend $1.5 million to $2.5 million on drilling, really seeking to add length to the mine life, increasing the reserve base, increasing the resource base, making sure that Pan continues to generate cash flow and provide that cash for the growth of the company for many years to come. One of the key things to remember, and particularly looking at those free cash flow numbers from the last 2 quarters, is we bought this asset plus Gold Rock plus Golden Eagle for the grand total of $5 million back in 2016. And again, Pan generated that much and more in free cash flow in either of the last 2 quarters of this year. So we think it was a particularly good, good use of funds to buy that asset. There are lots of exploration targets at Pan, lots of areas still to be drilled. It's a very big property. It's over 100 square kilometers. Over 200 square kilometers. And all of those red zones you see on the map on the right are exploration targets that have yet to be tested. We actually managed to get out and test the first one of those, called the Mustang target, which is just up to the northwest of the North Pit there. That had, I think, of the 8 holes we put into that, 5 of them hit. And we didn't put enough drilling into that to bring it into resources and reserves, but we are expecting to have a reserve and resource update later this year on it. We were hoping to have it by the end of September. We've run into a few slowdowns, interestingly enough, around some new SEC rules and potential liability for some of the engineering consultants that will be doing the work. So we've had to do a bit of extra work to support that resource update, but that's coming along nicely, and we should have that done in the next few weeks. And we did about 70,000 feet of drilling, or about 25,000 meters of drilling this year. So, and that's kind of typical of what we'll do in any given year. So with Pan operating really nicely, the focus is now on Gold Rock. Gold Rock is our growth project. It's about 8 miles away. You can see a picture there of the small former open pit that dates from the late 1980s at Gold Rock. And that shows you a couple of things. One is you can see the ore body very well, that kind of pinkish, whitish rock in the back wall of the pit there. That's the ore body. And the structure that controls that mineralization at Gold Rock runs for about 16 kilometers through this entire property. So there's lots of exploration upside there, we feel. And we're doing a fair bit of drilling right now to start to test some of that. The other thing it shows you is the pit walls are very steep. The pit walls have stood up unsupported in this open pit since it shut down about 30 years ago. No major failures, really just a little bit of small rocks tumbling down the face, as you'd expect. But what that shows you is that there's real potential, we think, as we go from the recently completed PEA into the upcoming feasibility study, that we'll be able to steepen up the pit slopes and reduce the strip ratio and reduce both the capex and the operating costs. It's one of the big opportunities we see moving forward with this project. But as I said, here's the property together. You can see both Pan and Gold Rock about 8 miles apart. The areas in red are the defined reserves and resources. The area in yellow are the exploration targets, and you can see a lot of exploration targets both at Pan and at Gold Rock. Highway 50 just to the north of us. Fantastic infrastructure in this area. There's no camp here. Everybody drives in from town. It's about an hour drive to work. We have grid power to the area, and we'll be extending that grid power down to Gold Rock over the next year or so to support the development of Gold Rock. And one of the things I should note about Gold Rock is that Gold Rock is federally permitted. That is the long, painful permitting process in the United States. We've got that behind us. We got our permits in 2018. And so now we're really free to push Gold Rock ahead on our own schedule at our own pace. Gold Rock has about 30% higher grades than Pan. About 80% of the resources are in the indicated category. It's about 400,000 ounces right now, another 84,000 in inferred. We're currently drilling, trying to increase the indicated and the measured resources at Gold Rock as we go into the feasibility study to support what we think is going to be a feasibility that looks even better than the PEA did. I'll just briefly talk about the PEA. And one of the key things to note about about Gold Rock is that it's really not a standalone mine per se. It's more of a satellite operation to Pan. As I say, they're only about 8 miles apart. Once that road is at its final stage that connects the two of them, you can see that black line, the access road to Gold Rock just extends down from the existing access road into Pan. It will be about a 20 to 25-minute drive between the two sites. And that means that you'll have the same administration team, the same management team, the same mining team, same mining contractor that are currently based at Pan. They'll be running both operations. So that'll save a lot in both CapEx and OpEx and in manpower at the site as well. The power line, there's already an existing power line into Pan. You can see it on that map coming in from the left. That yellow line will simply extend that and tee off of it down to Gold Rock. And that power line was actually designed with the intention of powering both Pan and Gold Rock. We'll also be pushing to use a lot of the same facilities, the existing facilities at Pan, the assay lab, hopefully large components of the ADR plant there that's already exists at Pan. And again, trying to use as much of the existing infrastructure to save on the CapEx and to save on the OpEx and to increase the efficiency of both operations. Some of the metrics on there will produce about 56,000 ounces a year, 6.5-year mine life. We're hoping again to extend that through drilling that's going on right now. We've got about 100,000 feet of drilling budgeted as part of the feasibility study, and that's about half completed right now. You can see at $1,400 gold, which is the base case gold price we used back in the summer when we put this out, pretty decent economics. Once you start getting up to $1,700, the economics start to look really interesting. And obviously at $1,900 gold, we didn't even do a $1,900 gold upside case at the time because that seemed like a bit of a stretch. Obviously not so much of a stretch today, but anyway, good numbers out of the PEA. And again, one of the things the feasibility identified was a lot of room to improve on those economics. And we're hoping to have that feasibility study done towards the end of next year. There's quite a lot of work to do to go into it. Metallurgy, geotech, resource updates, and all the rest. And then finally, Golden Eagle. This is our third project, and this is an often overlooked and I think very, very strongly undervalued asset. It's in Washington State, just outside the town of Republic, Washington. It's an old mining district. It's produced gold from 1800s up until 2017 when Kinross shut down the Buckhorn and Kettle River mines. There's still an existing permitted mill on care and maintenance at Kettle River, about 10 miles away by road. One of the nice things about Golden Eagle is it's a big project. This is about 2 million ounces of resources, 1.38 grams per ton gold. It's open pittable. It is a sulfide resource, so it will require treatment. It's not just a heap leach operation. But the key issue right now is that in order to put an open pit in there, we would need to push the margins of the pit and mine some waste into ground that's controlled on either side of us by Hecla. And we have been discussing with Hecla the possibility of combining our assets in the area. Hecla tells us that they've got somewhere in the neighborhood of 1.5 million to 2 million ounces drilled out, not to 43101 standards yet, but to their own internal standards. And by combining those, we think we could really have a fairly spectacular project and really one of the larger projects, undeveloped gold projects in the U.S. outside of the majors. And this graph really just tries to illustrate that. I mean, right now, on its own at 2 million ounces, Golden Eagle is about the sixth largest project in the United States, not controlled by the majors. So these are undeveloped projects. It's about the same size as Integra's De La Mar project. And, if you look at Del Mar and Integra, they have a market cap north of $500 million right now. Golden Eagle right now is sitting in Fiore Gold, which has a market cap of about 160 million Canadian dollars. And really that valuation comes from Pan and Gold Rock, not from Golden Eagle. So we think by spinning out Golden Eagle and ideally combining it with the Hecla assets to get it up closer to the sort of Midas Gold Stibnite project size, there's a lot of value to be unlocked there. But again, we're working on that. Discussions are ongoing. Probably not as quick as we'd like them. But fortunately, the holding cost for Golden Eagle is about $10,000 a year. From a working capital and a balance sheet and a capital structure side, I think we're very clean, very strong. 98 million shares outstanding, no warrants, 7.6 million options and RSUs. So fully diluted, we're at about 106. So very, very low dilution potential there. 23 million US in cash, very strong working capital and very strong, particularly relative to our market cap. Our market cap sitting somewhere in the 150 to 160 million Canadian. 5 analysts covering us, including Jacob Willoughby at Red Cloud, as well as 4 others there. We think, and every junior mining CEO has to say this, but we think we are significantly undervalued. I think on almost any metric, particularly compared to a lot of our single asset peers that are working in a lot of much dodgier jurisdictions than Nevada. Anyway, just to wrap up, we've really focused on execution, on trying to do what we said we're going to do. We got our Pan mine successfully ramped up and generating strong cash flow. Gold Rock permitted, pushing ahead on the feasibility study there. We got the PEA out and the resource update out on Gold Rock this year. We got a crusher installed at Pan and operating there to increase our recoveries. We got the resource update out for Golden Eagle. That's now current at 2 million ounces. Resource expansion drilling at Pan, and we're very close to getting the new resource and reserve update out. Coming up, we'll have that resource and reserve update in the next few weeks. Gold Rock feasibility study, that's kicked off already. Pan, I've mentioned that already. Pan and Gold Rock regional exploration. There's going to be a lot more exploration at both those properties this year and continuing on through the future. And my plan is that we're going to have rigs turning at one or other of Gold Rock or Pan pretty much consistently for the next couple of years. And then really looking at consolidation. We think there are a lot of small producers out there that don't make a lot of sense as single asset small producers. We think that bolting them together, making a multi-asset U.S. domestic gold producer in that kind of 150 to 250,000 range, that's our goal. But we think we've got a pretty viable plan to get us there. And I'll just leave you with a nice picture of the Pan mine, looking north there with the scenic snowy mountains of Nevada in the background. And I'm happy to take any questions, and thank you for your time.
Okay, great. Thanks, Tim. There are a few questions. We'll try and get through as many as possible. So first is a question asking from a participant, in case they missed it, if you mentioned the CapEx from the PEA for Gold Rock. Yeah, so the CapEx for the Gold Rock PEA is about $65 million US. And interestingly, about a quarter of that, about $15 million, is what's called capitalized pre-stripping. So that's stripping you have to do to get at the ore body before you can really start mining. And that's one of the reasons I pointed out that we're hopeful that we can steepen up the pit slopes, because that really cuts down on that capitalized pre-stripping and hopefully can have a big impact on that $15 million component. And of course, we'll update those capital costs as we get into the feasibility with a lot more precision than at the PEA level. But we think they're reasonably accurate right now. Yes. And then another question, which is a good question, asking, do you have enough capacity for the leach pads at Pan to leach the Gold Rock ore there, or would you need to go back through a permitting process to increase capacity?
Yeah, no. In fact, we will not build leach pads at Pan for the Gold Rock ore. Part of the permitted facilities at Gold Rock are for the leach pads there. And to be honest, it doesn't really save any money to build the leach pads at Pan. In fact, it's probably cheaper to build them at Gold Rock because we have a lot more room and a lot flatter ground to build them on. So I suspect it will cost less to build them at Gold Rock. You can't really haul ore, even at the sort of 0.6, slightly higher grade than Pan. You can't haul ore the 8 miles. Over to Pan economically. So what we'll do is we'll put the leach pads at Gold Rock and probably put carbon columns there, and then just truck the loaded carbon, which is a much smaller mass. It's probably a 5-ton truck every couple of days. We'll truck that over to over to Pan, and use the facilities at the ADR plant to strip the gold out of that, regenerate the carbon, and refine the gold there.
Right. And then so far, a final question from participants is asking, could you process ore from Gold Eagle at the Kettle River Mill?
You could, although it would need some modifications to the flow sheet. But the fact that Kettle River is a permitted facility, and one of the things I should say about Kinross is we have a very good relationship with them. Kinross actually is about a 6% shareholder in Fiore Gold. And we've known them for years. And they've been a very, very good shareholder to have, both on just technical discussions and things. They know our management team. They like our management team. If Kettle River were for sale, we would certainly be interested in buying it. My understanding is that at the moment is not for sale, but certainly that's a kind of an ongoing conversation that we have with them.
Right. So we only have about 30 seconds left, so I don't want to try and jam you with a hard question here. But someone is asking if COVID protocols have had any impact on your cost per ounce.
Yeah, really a minor cost, I think. We've occasionally we'll be short truck drivers or dozer operators, because if someone wakes up in the morning and they're not feeling well, our instructions to them are stay home. You'll get paid, but stay home, and really stay home until you get a positive or negative COVID test, or until the symptoms go away. And so, rather than us losing a day or two to an operator who's got a cold, we could lose a week, and so that's impacted costs a little bit, but not.
Okay, thanks for doing this. We really appreciate it.